This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with our experts Manus Clancy and Diane Crocker. For the week from June 9th through the 13th, some positive signs this week for investors on the trade front: a de-escalation with China. The administration says that the U.S.-China tariff deal is done and won't be changing. And consumer inflation this week was tamer than feared. Manus, this is all on the heels of the jobs report last week, which showed that it is gradually moderating. And these are all signs that the economy, while cooling, continues to be resilient.
It was an interesting week for data. We saw several data points, several news items. The winners, or the better than expected headlines, certainly outpaced the negative headlines. It continues a trend which we've seen for a couple months now, that even though there's been a lot of hand-wringing, including by me, that tariffs would have a detrimental effect and that maybe the markets were getting ahead of themselves, the data is telling us otherwise. Earlier this week, CPI came in lower than expected. Today, we saw another data point, PPI, coming in more benign than expected. All of this is good news. It goes to show that the fears that we all had that these tariffs were going to be passed on in higher costs to the consumer really hasn't turned out that way. Costs have come down now several months in a row since that April 2nd tariff announcement. And I think as investors, as borrowers, as commercial real estate landlords, as market watchers, as analysts, we have to feel pretty good. Those were two really good data points this week. The tariff news between the U.S. and China, also a positive. I know that there's still some I's to dot and some T's to cross on that, and they might be short-term deals at the moment. It is still trending in the right direction. We could feel good about that. And accordingly, if you recall, last week I said I thought the market was a little bit overly exuberant, that we went from overly panicked to a little bit complacent. Now I think some of that complacency isn't unjustified, or some of that enthusiasm isn't unjustified. We're seeing some pretty good data points, and it feels good right now. The one negative I would say is, given the CPI, given the PPI, I would have expected a more pronounced impact on long-term Treasury yields. The 10-year went from about 442 to 436, so trending in the right direction. We'd like to see that closer to 4% for CRE borrowers, for property values and so forth, but that will come over time. But generally a good week.
Yeah, I would agree with that, Manus. I think given the CPI report that we saw, clearly inflation isn't falling fast enough to give the Fed a green light, but it's not rising either, at least not yet. I think the concerns about tariffs are still out there, and everyone is expecting prices to rise later in the year, maybe once they burn through pre-tariff inventories, or test what consumers can tolerate in the form of higher prices. But I think this kind of middle place, this wait and see period, it's keeping everyone on edge. But I certainly think that the CPI report was encouraging. And I believe Fed Wednesday is next week, and it seems like it will be rather uneventful, because I think the likelihood of any interest rate cut is now essentially zero. But I'd agree with what you said on tariffs. I think that was certainly welcome news and potentially positive. It kind of brought to mind what Ryan Severino said on the pod back in February. You might remember that he said if Trump is using tariffs as more of a negotiating tool, or in a very deliberate way, like a scalpel rather than a sledgehammer, I think is how he said it, then the impacts will be less severe. So I think the market is kind of coming to terms with the fact that it will all unfold slowly over the next few months. I saw a term this week that I liked. They called them tariff table tennis stories. And I think that table tennis will be with us for quite some time.
Well, a couple of thoughts on this. One, I always feel time is the great equalizer when it comes to understanding how big an issue is. And the more time you can put between an event and catastrophe not happening, the more likely it is that catastrophe won't happen. And we are now 2.5 months, 10 weeks, give or take, post the April 2nd announcements, the fact that we haven't seen a hedge fund blow up, a retailer declare bankruptcy, a just complete rattling of investors through higher CPI and PPI numbers, that is just a great sign. And we should give credit where credit is due. I think in this case, maybe some of our listeners won't like this, but the White House is not exactly known for pivoting quickly and changing their trajectory on things. They tend to dig in. And it's not just this administration, it tends to be a lot of administrations. They take a policy path. It's what they want to do. They dig in. They don't change direction. I do think in this particular case, the swoon in stocks that we saw in April really forced the hand of the White House and forced them to take a long, hard look at what they were doing, and to the good. The fact that we didn't play this game of chicken very long was to the benefit of everybody, and I think that that's a good thing.
So while there was some good news, there were a couple things that may be concerning before we get to our May activity index, which I think a number of our listeners will be interested in hearing. The civil unrest that we're seeing in LA right now is unwelcome for lots of reasons. And without us getting into the politics of that, we've had a number of stories covering downtown LA and how it's a challenging market prior to any of this happening. So on that point, not good news for the LA market. Similarly, if this policy ends up being something that is replicated in other urban areas, if they're targeting 3,000 immigration arrests a day, that's triple the number of daily arrests that were made in the early days of Trump's term, which means you could see this spread to other urban locations, Newark, Chicago, Miami, and other places, which again would be not great news for some of these urban areas.
Well, let's start on a narrow basis, and then let's pull the lens back a little bit further. What does this mean for the CRE markets, the economy, and so forth? So when you look at the lens very narrowly, civil unrest in any market is not helpful to the commercial real estate market in that area. And sometimes, actually, the problems are bigger than the symptoms, if you will. And what do I mean by that? When you go back to, let's say, the 1970s or 1980s in New York, we had a lot of crime, we had a lot of neglect, and New York was stigmatized as a place where you didn't want to go. And it really impacted the city enormously. But if you lived here, if you lived in the suburbs, you knew the real story. There were parts of the city that were flourishing, and there were parts of the city that were troubled. But once you got beyond that radius of the tri-state area, New York, New Jersey, and Connecticut, you were stigmatized. People didn't want to come here for vacation. And that's what happens when civil unrest takes place, right? I think it impacted places like Portland, Seattle, and Minneapolis to a very painful degree a couple of years ago, and maybe unfairly. I don't know those markets very well, but I imagine that people that might otherwise have gone to see a play or gone to a restaurant said, you know what, let's stay in the suburbs tonight. Let's not stay in a hotel downtown. And the risk is that that's what happens to Los Angeles. People say, let's not make our employees come down here. Let's think about getting office space outside the CBD. And that's the painful reality of it. And sometimes what you see on TV stigmatizes an entire MSA. And I hope that that doesn't happen.
Yeah, I think it's an important nuance, especially at a time when attention is being drawn into the revitalization of downtown areas. Now, if we have the widespread unrest that you just mentioned, that could potentially extend outside of LA. If these raids extend into other metros, that could have obviously a very real impact on decisions companies make about where to open offices, where to have their employees. There could be an impact on retail, since so much of that spending happens at the ground level. That could be very widespread depending on where this all takes us.
And we had some other stories that were worth watching, a ruling on eviction bans and a shutdown for FEMA. Let's first talk about the eviction ban. This was something that came out of the COVID pandemic, where you saw the CDC ban evictions during the period of COVID. And I recall at the time we talked about whether or not that was within the law's limits. It seems that now a federal court has ruled that there are legal claims brought by landlords that must be
addressed?
Well, it's good news for landlords. I think that landlords in general were really punished over the last couple of years on several fronts. The eviction ban, very painful for landlords. I also think that in certain markets, these rent caps, especially in New York, on how much you can increase rents in the affordable, the rent stabilized, the rent controlled markets really squeeze landlords. And let's not kid ourselves. It doesn't just squeeze landlords. It squeezes the tenants themselves. Yes, they might get the benefit of their rent only going up 2.9% year over year, but rest assured, they're not going to see the hallways painted. They're not going to see the rugs refurbished. They're not going to see the roof patched on time. They're not going to see exterminators coming into the building. So anything that kind of takes the shackles, if you will, off the landlords and gives them a little bit more breathing room is a good thing. So I'm happy about that. I will pivot when we talk about the regulatory to a different story. I'm not sure if you saw this, Martha and Diane, but just today, I believe, or yesterday, a law went into place in New York where landlords can no longer allow brokers to charge fees to people looking for buildings in New York. So in the past, somebody looking for a 2-bedroom apartment, maybe a couple people just graduating from college, might have paid 15% to a broker to find them an apartment. That's now become illegal. That's not allowed. And Street Easy in New York, which is a source of this type of traffic, kind of the Craigslist for renters, saw a drop of 1,000 listings just overnight. So what that impact is remains to be seen. Something tells me, sadly, that these young kids are going to have to walk around New York with $1,000 in their pocket in cash to find an apartment. I don't know. I'm not sure it's a well thought out law.
Something to watch, Manus, that I wanted to point out is that on the lawsuit, the latest decision does not award damages, but what it does is allow plaintiffs to move forward with claims that their constitutional rights were violated and that the federal government may owe them compensation under takings law. So, it's interesting. If it's successful, the case could open the door for compensation for landlords who are affected by emergency orders. And it also reignites debate over government limits in private housing markets. So it shows that regulatory intervention is a real risk for anyone who's thinking about investing in multifamily.
I hearken back to something Bob Knakkel said. I'm not sure if it was in the most recent podcast we did or the one prior to that, but the 800-pound gorilla in the housing market in these major metropolitan areas is the government just getting out of the way. Right. Bob says, these zoning things which cap the height of a multifamily building that you could put up or keep things under wraps by keeping them under the rate stabilization or rent control moniker and keep them kind of controlled under the just vast levels of paperwork and rules that have to be met. Get out of the way, free up the space, let more development to happen. And what you would see is more product and lower rents. People talk about this all the time. Nobody really does anything about it, but Bob has the right answer for this, right? Take the training wheels off and let developers develop.
And I mentioned the shutdown for FEMA that was announced this week. President Trump has announced plans to start phasing out FEMA after the 2025 hurricane season. And this has some impact on the commercial real estate market.
It definitely does, Martha. That was a drastic policy statement by Trump. FEMA's budget is $33.1 billion. They have more than 20,000 employees nationwide. So phasing out FEMA is something that will have a significant impact just on that. And the other kind of obvious impact is that it would shift the burden of disaster recovery and rebuilding to states, to private insurers, to property stakeholders. So what does that do? Well, it raises the cost of capital. Insurance costs are already skyrocketing, so those would go up even more, and development costs would increase. So, I think the impacts, could be significant and widespread if federal aid is less reliable. It leaves developers, lenders, insurers to absorb more risk or maybe pass it on to tenants and buyers. LightBox has flood risk models and rebuild cost data already that show that billions of dollars in commercial real estate exposure sits in these zones that are FEMA dependent. So if those federal safety nets shrink, then pricing and development feasibility in coastal regions that are at high risk of storm exposure could definitely see a reset. And then I think it really kind of heightens the imperative for any stakeholders in those areas to really kind of think long and hard about climate resilience and planning. Think about measures to mitigate climate risk. And owners who embed resilience into their operations, I think, will be better positioned to weather a world where FEMA support might not exist or could be dramatically reduced. And I'll mention here, Martha, that next week we are lucky to have a preeminent expert on property resilience and climate risk. That is AEI Consultants Holly Niebuhr. So this is a great topic to talk to Holly about.
Let's turn to the LightBox data dive. We've talked about the May CRE activity index, which was released at the end of last week, and we did see a change in the momentum of deal transaction activity. Diane, tell us what happened.
We did. Back when the April index came out, the pace of growth had started to moderate, but it was still an increase over March. So it was interesting. In May, the index slipped to 105.5, which was down from 109 in April. And that was the first monthly decline of the year. Obviously the question is that a potential inflection point for the market? Is it the sign of a long-term trend, or is it just a tapping of the brakes? For those listeners who haven't tuned in to hear us talk about the index before, it's an aggregate measurement of market velocity. May's is built on 28,500 data points across appraisals via our C360 and RIMS platforms, environmental due diligence reports via EDR, and new property listings via our RCM and Revere platforms. So all of this kind of tracks the pulse of pre-transaction activity. So if you're trying to spot turning points in commercial real estate at this volatile time, consider the index kind of our early warning system. So let's talk for a second about the small dip that we saw in May across those three components. The average deal flow of property listings increased 1% compared to April, still 47% above last May. So I'm very encouraged by the fact that listings are still coming in at a very healthy clip. The volume of environmental due diligence was relatively flat for the second consecutive month, but still 7% higher than last May. So another encouraging sign. But it was the lender-driven commercial appraisal awards that fell 19% below April. And that was the first month-on-month decline since December. It took our volume back to where we were back in January. So this, in my mind, is reflective of lenders who are seeing the storm clouds. They're worried about the uncertainty. They're hearing the chatter about sentiment starting to erode a little bit, and they're pulling back from the strong momentum that we saw in the first 4 months of the year. We're just 2 weeks away from the mid-year point, so I think the June index will be very, very telling. And I wanted to add, Martha, another encouraging point is that along with the May index, we just published a rundown of big deals that happened in May. And the good news is big ticket deals are still getting done. We had 45 nine-figure transactions that we watched close in May, and that edged up from April. So that to me tells me that there's strong conviction among institutional and private equity buyers. We saw a little bit of a slowdown in the $50 to $100 million range where maybe tighter credit is sidelining some smaller players, but clearly capital hasn't exited. And I think it's just being more selective. And one last thing that I'll mention is that a trend behind this is a lot of what we're seeing in office and the stories that we highlight here on the podcast. CBRE came out with an interesting stat, got a lot of headline exposure last week, and it's worth mentioning here that for the first time in 25 years, more office space in the U.S. is being demolished or converted than newly constructed. For the first time in 25 years. So by the end of 2025, 23.3 million square feet will be removed through either conversion or demolition, and only 12.7 million square feet will be completed. So the trend's being driven by remote work and high vacancy, and it's leading to this focus on Class A office properties. So I feel like in office, it's differentiated. These shiny Class A top 10% in office is what's driving leasing highs in our downtowns. And then you have this bottom 10 to 20% that's effectively obsolete. And the middle is kind of in this existential crisis for relevance. So there's a lot of opportunity, I think, as old space gets reimagined. So that's my take on office, Manus. I know that you watch transactions closely. What are you seeing in the other asset classes?
Wow, a lot to peel back there, Diane. At the very high level, before I get into the property types themselves, I think two things about what you mentioned are actually glass half full points. The fact that the index dipped only slightly, I actually think is a bullish sign that we didn't see activity fall off the cliff after April 2nd, now that we're 2 months into this data. I think is quite encouraging. I think also encouraging, when you talk about all these conversions taking place, this is not for the faint of heart. If you're going to convert something from an office to a residential office to a hotel, you are taking on a lot of risk as a developer. This is a capital intensive project. You need a lot of equity. You need a lot of time. You need to make sure that the numbers add up at the beginning and then they come through as you reposition this property over the course of 3 or 4 years. You also need a hearty conviction if you're a lender. A construction lender is putting a lot of money on the line for these types of things. And the fact that so many different entities, developers, have put their money where their mouth is, and so many different lenders have done the same, is a really bullish indicator for the market, in my opinion. I think that's quite encouraging. I love your thoughts on that.
I would agree with that. And that's why I think, June, July, August will be very telling, especially because of the things that we've talked about here already. What happens with the labor market? What happens with construction costs when tariffs really start to take hold? And as an early indicator in the market, if tariffs, if higher prices, if harder to get construction labor really start to impact projects, then we should start to see that reflected in the index in the coming months. So I certainly think it's worth watching, but I agree. What we're seeing so far is expected and certainly not concerning.
I'm going to make a call here, and my call is going to be that we are going to see CRE really take off in the second half of the year. I made a presentation earlier this week about what we're watching, and it's going to be no surprise to our listeners here. It was no surprise probably to the audience. We're watching interest rates, we're watching volatility, we're watching tariffs, and we're watching economic signals, CPI, PPI, unemployment, GDP, et cetera. And I mentioned that if all four of those items trend in the positive over the next 6 months, you can expect a really, really healthy rebound in the second half of the year. I said if half of those items go to our benefit, if we see lower rates, lower volatility, but tariffs are still an issue and the indicators are mushy, it'll be kind of bumping along like we saw with the index this month. And I said if we go 0 for 4, it's going to be back to 2023. We're going to see a very difficult CRE market. What we've seen this week is positive news on tariffs, positive news on inflation, positive news on interest rates, and with that, a fall in volatility. So we kind of went 4 for 4 this week, and it's got me feeling pretty good about the second half of the year, at least right now.
So listening to what you just said, Manus, really reminded me of something that we're being constantly reminded of now, and that is investing in commercial properties. It's a long game. It's not a short scrimmage, and I think the deals that we're tracking show that buyers are moving in. They want to hold properties, sell them for a profit, maybe years down the road. So, all the political drama, the latest was the Elon Musk and Trump drama of last week, trigger short-term volatility. It grabs front-page real estate, but temporary disruptions often give way to longer-term opportunities. And I think that's the case in office right now. So, I asked you before, what have you seen in the other asset classes besides office? What are your thoughts on recent multifamily, retail, industrial deals?
So taking it from the top, I will start with multifamily. There are some real trends that we're seeing right now that seem to have spread over many, many months and seem to be enduring. Others that are just kind of picking up now, and I'll go through them. Let me start with apartments. What we're seeing now is apartment sales. That's the dog that never stops hunting. Every single week, 5 to 10 sales of 100 million and up, diverse buyer group, diverse seller group. The pool of buyers is very, very deep. Capital is available. Cap rates have come down considerably. And what we're seeing here is, unlike in office, we're seeing people actually trade these things with decent returns from where they bought their properties a couple of years ago. I'll highlight three. In Westboro, Mass., the Park Westboro sold for $96 million. The buyer there, Apollo Commercial, the seller, Cottonwood Residential. The sale price, a 47% uptick from the 2018 acquisition price. In Sterling, Virginia, the Chase Heritage Apartments went for $72 million. This property last traded in 2021. The buyer there is paying a 25% premium over the last sale just 4 years ago. The buyer there, True America, the seller, McDowell Properties. I'll give you one more. In Kirkland, Washington, View Kirkland. This property traded for $55 million. That's a 35% uptick from the 2015 price of, let me do the math. Let me take my shoes off here, $41 million. The seller there, Acacia Capital. So what we're seeing here, there was a narrative for a long time that if you bought in 2021, you are considerably underwater. But when you look at that Sterling, Virginia sale, the Chase Heritage Apartments, this was sold in 2021. The seller made 25% on their transaction. So the apartment market, very, very healthy right now. In contrast, offices, you mentioned this before, what we saw this week, three that met the narrative on the other side. In Los Angeles, 601 South Figueroa, sold for $210 million, 40% discount to the 2005 sale price. In Atlanta, the Piedmont Center was sold for $200 million, a 47% discount to the 2021 sale price. In San Francisco Market Center, that sold for $177 million, a 75% discount to the 2019 sales price. So themes emerging here, or at least staying in place. Apartments, pretty good. Offices, not so good.
And that was an impressive range of transactions that you just ran through, Manus. And I think it really highlights how differentiated our market is. And we've heard that from past podcast guests as well. What really matters is an individual asset, and one multifamily property is very different than another based on the market that it's in, based on the condition that it's in, based on what fundamentals like rent rate or occupancy are. And I think those fundamentals and the data, not fears about the market, are what will really shape the future and shape the decisions that are being made behind the transactions that you're watching.
Manus, I know you had also some updates on retail and hotels.
Yes, I'll go through these very quickly. This is a theme that is more recent in each case. The retail segment and the hotel segment, just like I said, the apartment segment was the area where the dog was always hunting. Retail and hotels was the area where the dog was never hunting. We hadn't seen a lot of high-ticket retail sales or hotel sales over the last 6 months. That seems to be changing just a bit. We saw in the hotel segment 3 sizable sales recently. We talked about this 2 weeks ago. The JW Marriott in Phoenix, $800 million. In Boston, we saw the Courtyard Boston Copley, $50 million. In San Francisco, the Hyatt Centric Fisherman's Wharf, 80 million. We're starting to see some hotels trade at big numbers. That's an encouraging sign for a market that had been quite locked up. In the retail, kind of similar. In West Palm Beach, all of these are in Florida, by the way. In West Palm Beach, the marketplace at the outlets sold for 133 million. That was acquired by Invesco. In Davenport, FL, Posner Commons sold for 63 million. The buyer there, Orion Real Estate. And then just today in South Florida, this reporting coming from Commercial Observer's Julia Etchickson, Commercial Real Estate Corp, bought the City Place Doral retail component of a mixed-use development, paying $88 million for that particular asset. So a couple of trends that make me bullish in retail and hotel going forward. Some good news there.
So retail is not the only thing that's driving transactions in Florida, Manus. There was a story about Zara, which is a retailer that I know my teen daughter is very familiar with. The founder of Zara, Amancio Ortega, acquired a 259-unit Venado Las Olas apartment tower in Fort Lauderdale from Related Group for $165 million. That was one of the largest multifamily deals this year. It was reported by Commercial Observer and The Real Deal. And per unit, the cost was $637,000, which is pricey even by South Florida standards. And what really jumps out about the story is that at a time when institutional international flows are down, over the past 12, 18 months, total investment volume in Florida's commercial real estate has declined. But this family office, Ponte Gadega, has been quietly snapping up trophy assets across the U.S. for the last decade, from offices in New York to high-end residential in Miami and even Seattle. Looking, Martha, at our LightBox data, cross-border commercial real estate transactions in Florida fell by double digits last year compared to peak pandemic years, when back then Florida was seen as kind of a safe haven for international capital. So Ortega, maybe isn't a trend follower here, but a trophy hunter. And maybe this deal isn't part of a wave, but just more of a targeted bet on a luxury asset. It's in a top-tier urban market. We're seeing more and more happen in Fort Lauderdale. So maybe in a cooling market, standout assets like this are still attractive and drawing global money.
If I'm not mistaken, the buyer got quite a deal there. I think the property was originally listed for $230 or $220 million. So getting it at that 165 price sounds like a steal. If imagine saying that, oh, you paid $165 million, you got your deep discount. That's something I never thought I'd hear coming out of my mouth.
And of course, Father's Day is this weekend. Father's Day spending is expected to reach a record of $24 billion. This figure is an increase from 2024, where it was about $22 billion, and exceeds the previous record in 2023. Manus, the average person is going to spend around $200. What $200 surprises are you hoping for this weekend?
Well, let me start by saying I don't expect any of my children to spend $200 on me, and I might even be annoyed if they did. A nice I don't know, set of socks or something like that is fine. I don't know. I really don't need anything. I'm pretty happy where I am. If somebody was going to splurge on me, I'd say I could use a nice 3-wood for my golf game. But even that, I really don't need anything. I'm quite content. Bring me a bagel with and everything bagel with butter when you come over my home this weekend. Make it nice and fresh. Don't get me one of those shrink wrap things, and I'll feel pretty good.
Not a hammock or an axe throwing excursion, Manus?
No, I'm pretty good. You come over. I don't even need socks. Just come over, bring me a bacon, egg, and cheese on a roll. Bring me a fresh bagel with butter. That would more than make me happy. Find me a Barron's so I don't have to read it online. I'm good.
I love it. Martha, I just want to give a big shout out to any listeners who are parents with graduates crossing the stage this week. My son is graduating from high school, and getting him across the finish line post-COVID was honestly no small feat. So congratulations to everybody who has students who are crossing that stage to get their diplomas.
Both a gift and a curse, right? So happy for their achievements. So sad to see those hefty checks getting ready to be written for so many parents.
Congratulations. And kids, if you're listening, Manus wants a 3-wood. Thanks to our producer, Josh Bruning. Please join us each week as our Lightbox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.